The big thing about homeowners insurance is that people just say, "I'll just give me whatever," and they don't think about what it is they're actually buying.
Today's guest is Dr. Martin F. Grace, who is a professor of risk management at the Tippie College of Business at the University of Iowa. We're here today to talk about the exciting topic of homeowners insurance. So, Professor Grace, I imagine you might be getting a lot of questions recently about this topic as we've had Hurricane Helene that really affected North Carolina. We also had Hurricane Milton affected places in Florida, and I think they combined for something like over $200 billion worth of property damage. We have reports, I believe, from NOAA, I believe it is.
The National Oceanographic Administration.
Yeah, since 1980, they estimate something around $2.7 trillion worth of damages from weather and climate disasters in the U.S. And since 2014, in the last decade, that's over $1.2 trillion. So about half of that's been in the last decade. And that probably doesn't include the 200 billion or so that we've experienced in the last few weeks. So are we going to have more of these storms, and how does this affect homeowners insurance? I was reading a New York Times article. I think they were saying like 17 of the 50 states, the insurance companies have lost money last year in 2023. And 2024, I imagine that number is going to be the same, if not more.
Well, I think that there's probably four reasons that homeowners insurance in particular is under stress right now. And a lot of it has to do, and what makes it easier or harder for people is where they actually live. So let's start with the big one. So the big one is that home values have gone up dramatically since around COVID time. And that had to do a little bit with people sort of rearranging their lifestyle to work at home in places that they were more comfortable with and cheaper maybe. And so the demand for homes outside of New York City went up dramatically. And in Florida, it went up even more so. And so if you think about Florida, that just the value of a person's house might be 30, 40, or 50% higher than it was 5 years ago. Well, all that by itself means that, if your house goes from $200,000 to $400,000, the amount of insurance you have to cover that risk, because it's not magic. If you were to lose your house, you would want to sort of get your money's worth in replacement value. So if the house is now double, insurance is going to go up. It probably won't go up double, of course, but it goes up. So in Florida and other places that saw people moving into Texas, California, and in the nicer parts of California away from the city, the house values went up dramatically. And it happened all across the country too. It wasn't just those places, but I think in those places it's worse because everybody wanted to move there. So home values going up. Well then, so that's a demand shock. So everybody wants to live in a different place at the same time. Well, at that same time, we had the supply shock. And the supply shock was that everything got shut down. That supply chains got disrupted. And people moved. Even construction workers moved. Everything was out of whack for a while. So in order to get, after the COVID was over, in order to get people back, we had to sort of entice them with higher wages. And this is even before we think about government programs like the things that we got during COVID to sort of to provide us with unemployment insurance and things like that. So that was very generous, and it made people think that they don't have to go back to work right now. Well, in turn, that caused companies to actually raise rates, wages even more. So we had this demand shock and we had a supply shock. And the supply shock wasn't just wages like construction worker wages and other kinds of wages. It was also for, the materials. In order to rebuild a house, you need lumber and you need cement, you need other things, and they are now more costly. So we had this demand shock and we had a supply shock. And at the same time, we had inflation, caused probably by the amount of money we gave for COVID relief. And then we had this Build Back America legislation that was another $1 trillion of money in the economy that also causes inflation. Now, the good side of that is that inflation seems to be moderating. So a lot of the pressure that we had on homes is over. A lot of the pressure on prices is likely over. So insurance prices are likely to mitigate. That means they won't fall probably, but they won't be increasing at the dramatic rate they have been in the past. So we had a confluence of these things. And of course, you throw on some natural catastrophes on top of that, and it makes things appear much, much worse. So in Florida, for example, or in wildfire areas, or even in the Midwest where they have convective storms, those things seem to be on people's minds a lot right now. And they have an effect on insurance and insurance pricing in those states. So I'd say, it's a whole bunch of things that had a confluence in the last 5 years. And it took a while to notice it, but we noticed that we were shocked. But now I think we're seeing a little bit of relief coming in the sense that inflation's over. And so a lot of the things that raise the value of the home or raise the costs of repairing a home, are back into equilibrium.
It kind of sounds like you're basically saying that with all the money that was injected into the kind of the system during COVID, and then with people kind of flooding into certain areas, like I know, North Carolina, Tennessee, and Florida, especially during COVID, that maybe those prices were almost artificially high, and then you get a massive storm that comes in, and so those numbers might be a little bit inflated. Is that?
No, I don't think. No, that's not quite the way I would think about it. So I think those prices aren't inflated. Those are the prices now. Okay, so they've gone up, and that's the new equilibrium. Now, if people start to move out of those places, I think prices will fall. Again, like if people say, well, I didn't realize North Carolina was a flood risk. I'm not prepared for flood risk. And this was a terrible disaster. I don't want to live here anymore. Well, they'll move someplace else. And that means whatever house they're living in, they'll sell, and that will provide downward price pressure on that market. So people do move around. These are equilibrium things, and the government's policies do have an effect on it. But I really think this is a COVID problem. It sort of relocated people to North Carolina, to Tennessee, to Florida, other places along, that people might think are nice places to live. And that, was the big thing. And then, we threw money at, I would think, reasonable amounts at first to make people not destitute, so they could still pay rent, they could still eat and things like that. But I think we sort of overdid it a little bit, and that it caused people not to want to go back to work because they still had funds available. And that's when the labor cost inflation started to happen. And I think all that's pretty much gone now. I think we're back in an equilibrium of wages going up, reasonably, and prices moderated dramatically. That's what the Federal Reserve Board of Governors seems to think right now, and I hope it's true.
Do you think the home prices right now are fairly stable? Like they're not going to be going up much higher than they currently are?
We don't have. See, I think prices get volatile when we have a shock, and right now we don't really have a shock. We're back in the pre-COVID markets, except prices are higher. That's what normally happens with inflation. Inflation doesn't. When it goes away, it just means that prices don't rise anymore. The deflation would mean that prices go back, and we don't have very much evidence of ever having much deflation in the United States. There have been times of the Great Depression, for example, but it's normally not something that we have to deal with.
I was reading some of your articles and looking at some of your articles, and you've been writing about homeowners insurance and natural disasters for well over 20 years. So how have the trends changed from when you first started researching this to now, almost, in 2025?
That's a very interesting question, and thank you very much for reading my papers. In Hurricane Andrew, which was kind of a shock to the insurance market because we hadn't had a large hurricane that hit near a populated area since like 1969. I think that was Hurricane Camille. And so from between 1969 and 1992, there have been a couple of hurricanes that hit the United States, but they were mostly non-events, unless you lived on Long Island and your yacht got turned over. That was, I think, Hurricane Bob. But that was kind of an interesting hurricane. People didn't think much about it. But Hurricane Andrew and the size of it and the force of it made people change their mind about hurricane risk. For example, I'm going to talk about Florida just because I know it. And Florida, the way people sold homeowners insurance back in the early 90s was as a loss leader to get them to bundle with auto insurance. And so people gave away homeowners insurance just so they could get the auto business. Well, what happened was that, people were incentivized to like pick up whole zip codes, pick up whole areas of a county, pick up whole areas of a town. So we had this massive concentration of risk by like State Farm and Allstate, which were the two biggest companies at the time, I believe. And so they were proud of the fact that, they had significant market shares in Florida for home and auto. Well, after Hurricane Andrew, they said, oh my gosh, what we did was we concentrated our risk, and we just can't afford to do that. So what they did is almost overnight, they said, well, we're not going to insure in many of these places. We're going to say we can only have 3% of the market or 7% of the market. And they were dropping, insureds like crazy. And people were upset because they'd been with that insurance company for a long time. And the company was sort of reevaluating the risk on the backs of those particular homeowners. So the state got involved, and the state said, well, you can't do that. That's unfair. And they started regulating relatively strictly how insurance companies could readjust their portfolios. And it may be only like 5% of customers a year could you drop and things like that. And the idea was to sort of manage the reallocation of insurance around the state. Well, that turned out to be not good enough, and people weren't able to get insurance, and so they were going into it was called a joint underwriting association. And what this was really the insurer of last resort. Companies in the state that sold homeowners insurance were the backers of the JUA, the Joint Underwriting Association. And if losses were high, the members, which were the state market, had to make up the losses. So it was like, if you couldn't get insurance from a regular company in the voluntary or private market, you could go into this secondary market. And it was the same companies backing the insurance, but you had a piece of paper that said it came from the Joint Underwriting Association. But it really didn't change anything. It just sort of shifted around and gave people an opportunity to get coverage when they otherwise couldn't. Over time, that Joint Underwriting Association became the Citizens Property Insurance Company of Florida. So the state took it over. And there have been a number of different things going on with that over time. But one of the big things was that, more and more and more people were members of the state insurance company, Citizens, and fewer people were in the private market. And, the state was saying, oh my gosh, we are now the biggest owners of hurricane risk in the state. It kind of undoes what insurance is supposed to do, which is to diversify risks throughout the capital markets, across countries, across states, across time. But Florida, was because it owned at one time it owned over 50% of the insurance market. It had concentrated the risk into taxpayers' hands. And depending upon the governor, some people sort of react, that's not fiscally responsible. We need to put the people back into the private market. Well, the private market, this is a long story, but it's almost over. The private market says we don't want any more. And so what the state did is said, let's incentivize people to take these customers. So they called it a depopulation program, and they encouraged companies to come in, and they would give them a subsidy to take over the customer. Now, many of these companies just don't have the same staying power, if you will, as an Allstate or a State Farm or a USAA or a Liberty Mutual. These are the big name companies that sell home insurance, and these companies, they could basically survive if there wasn't a catastrophe. And so every time after that, if we saw a large storm, we often saw insurance company failures. And this was happening almost the same story was happening in Louisiana at the same time. So, we would see catastrophes and we would see insurance company failures in Florida and in Louisiana for the reason, because these companies that the state was trying to entice in just weren't as strong as other companies. So over this time period, we've gone through this whole system of trying to, regulate insurance, keep prices low, but that just encourages people to come into the state in many respects. Because if prices are really good, if insurance prices are a really good deal, it reduces the total cost of ownership of my home. And if the price was more accurately reflected, people would say, oh, should I build and live on the coast, or should I maybe move to Central Florida, or something, a little place away from the coast? So these, in pricing plays an important role. And part of, I think, Florida's hurricane policy and most states' natural disaster policies is to try to reduce the effect of price on insurers. And one can understand that from a political point of view, because think about it, you're a state legislator and your constituents are saying, hey, my insurance prices are too high. And they say, oh, we have to fix that. And so they're in fixing mode. But doing that, I think, hurts the long run viability of the state's insurance market. And it hurts because we're still building in places that are very, very risky, and people aren't paying the full freight for that. So that's kind of the long story, the last 25 years of sort of the work I've been doing.
We hear about how we've had more, the strength and the frequency of these storms every year gets worse and worse. But it also sounds like what you're saying is that, especially like in Florida, there's just more homes built in places where there shouldn't be, and then they're paying way too cheap of an insurance to cover that house.
Yeah, so I don't know I don't know what way too cheap. It just doesn't provide the right signal. So it's just a good deal. I can live in paradise and not have to pay the full freight. So it could be 10% more, it could be 20. I actually don't know that number because we're all disorganized in the sense that prices haven't reflected risk in probably 30 years. And even before that is probably not true, because homeowners insurance was underpriced, to begin with. But one thing that Florida has tried to do, it has tried to understand, and other states have done this too, how can we build homes better without dramatically increasing the price of a home? What can we do to make them more resilient against wind? And there are programs that are very effective at this. And some of the things, I'm not an expert on this building construction part of this, but I've talked to people that are in the know, and some of it is, tying down your roof a particular way, putting shingles on slightly differently to protect the roof from wind and debris that might scrape off shingles. And that has a major effect on how much water gets in your house. And when you reduce the amount of water in your house, your damages go down dramatically, because you don't have the mold and the mildew. Because if you think about a typical hurricane, your electricity and air conditioning is gone. You have a hole in your roof and there's water just pouring in. And that just creates mold and mildew until you can get your air conditioning back up. And then you have to rip out all the mold and mildew, which, some of the mold is poisonous to people. So it can be very expensive to remediate.
Since I just mentioned the two hurricanes, Hurricane Helene and Milton, I mean, anytime we have these storms, you're always going to hear articles about homeowners insurance. But it seemed like, you hear a lot, especially in California, where there's, with all the wildfires, that insurance companies are pulling out. They say the same thing in Florida. I mean, is this true? Like, do we have to rethink homeowners insurance in the U.S., or is this overblown?
Well, it's it's become a political problem. And once it becomes a political problem, it's never overblown. It's just the political problem. But California won't let insurance prices rise. And so companies are saying, you're asking us to take on risk and we can't make money taking on this risk. So we're no longer going to write insurance. And that's a typical market response. If no one's willing to pay for it, or in this case, the government says you can't charge more, the market falls apart. So what would be a thing that you could do? Well, you could let the insurance companies raise prices and adjust their underwriting so that if companies have an opportunity, homeowners have an opportunity to mitigate their risk, they might be able to take advantage of any credit or underwriting class change that would give them a lower price. But if you don't allow prices to go to their level of risk, people don't have an incentive to do that. They say, well, I don't have to do that because the insurance, I can still get insurance. I don't care. I think what's going to happen is that people are going to be responsible more for the losses at the beginning, their deductibles, for example. Or like in Florida, I think there's deductibles in the percentages. It used to be that you'd have a $100 or $500 deductible. Now you have a 10 or 15% deductible. And for a $500,000 house, that can be real money. So they're taking on more of that risk, and they have an incentive to sort of, take care in a way that maybe you didn't before. Now, I know that Florida has wind mitigation credits that allow you, if you have like roof straps and other types of things, you can reduce the cost of insurance by half. But I lived in Georgia for many years, and my homeowner's insurance, I don't know, maybe $1,400. And in the same price house I have in Florida, it's like over twice that amount. And that's with the credits and everything, but that's basically because of the higher risk. And, prices are going to be higher in higher risk areas.
Is there any states or places that you would recommend not moving to due to homeowners insurance?
Well, that's a hard thing to do because people have so many reasons to live where they live, right? And it's just that the price of insurance is different in every state, really. And so if you want to live in Florida or if you want to live in the mountains in California, that's kind of your right. And as long as you can afford the total cost of owning your home, I have no problem with that. So I really wouldn't want to say don't live someplace. But I would want to say that this is slightly different, and it comes up with kind of a question you didn't quite ask yet. But if you live in an area that is prone to floods and you're not in a flood zone, because the map says you're not, the official flood map says you're not in a flood zone, I wouldn't say that you're home free at all. Even though the federal government is trying to create better and better maps, they really can't keep up. And this example in North Carolina, where Helene went there, people would never probably thought that most of that area that got absolutely deluged was a flood risk. So that was kind of like something new. That was a new kind of risk, kind of like Hurricane Andrew was a new risk, where we had hurricanes before, we've had floods before, but we had one in an area that we'd never seen before, and it was a lot worse than anyone would have expected. And people were saying, I didn't buy flood insurance because I didn't think I needed it. And the maps, if you can go to the National Flood Insurance Program and type in your address and see exactly what the federal government thinks your flood risk is. But that's a super good guess. But they have evidence why they draw those flood risk maps that way. But it's not necessarily the be all and the end all. So you're still holding risk when you live near a flood zone. And even if you don't live near one, and there's water in the world, you're still exposed to that risk.
Since you're talking about Asheville, as you mentioned, basically none of those people anticipated that they would ever, be flooded out. And your standard homeowners insurance doesn't cover flood. I believe that less than from the reports that I was reading was that less than 5% of the people in Asheville even had flood insurance, which means that 95% of the homes had zero coverage as their standard homeowners insurance wouldn't cover it. So what do those people do? And does FEMA step in and give them some money, or what's the course of action? What's kind of the process that's going to partake or, kind of go forward the next few months to years?
Well, there may be some FEMA money for, and I'm not an expert on these after the disaster funding mechanisms. I know that for small businesses, there's loans, and there's for homeowners, there's also loans, and there might be grants if you satisfy some income constraints or limits. But it's going to be mostly on the homeowner. I mean, with the modest exceptions. I don't think FEMA wants you to buy homeowners insurance. They're not going to say, "Oh, if you're flooded, we'll pay for it anyway." They won't say that, but they will try to say, here's money available that we'll give you at slightly below market rates to help you rebuild, but you still have to pay it back. It's just like a regular loan. So there's some grants, as I said, for people that have income below certain levels, but for the most part, people are in the market for a loan. So this is a terrible position to be in, and you can't blame people for not knowing the risk, because the government tells you, and this is the best information. It's not like the government's lying to you either. It's the best information. They think there's little or no risk in this area, but they didn't model Hurricane Helene. And I think that's causing all sorts of grief at people who think about these things right now. So we've been doing standard kinds of things. We've been looking at, rivers changing 10 miles away or 50 miles away and how that affects, here. We didn't think about a foot of water being dumped on us overnight. That's a whole different scenario. I suppose they'll be thinking about those things now, but it's a novel risk. And the first time you have a novel risk, it seems very different. Because hurricanes in Florida are still happening, but Florida seems to get its act together very quickly after them. And because the state is set up, FEMA is set up for Florida. They know how to do it. All the weather people are there. They know which hotels to stay at. So everybody understands Florida. But when it happens someplace else, it's very, very different.
You used to teach at Temple, and you used to teach in Georgia, and now you're at the University of Iowa. You've done this for decades, right? I mean, what are some common questions that you get? What should people know that, this is a topic that I don't think people really get too much information on. And if they do get information, it's probably too late to have inputted that it's information prior to a disaster.
Well, I would think that, so lots of people, once they pay off their house, will say, well, I don't need to have homeowners insurance anymore. Don't ever think that, because your home is money in the bank, and you wouldn't want to leave money in the bank unlocked. And insurance is basically the guard dog for your money in the bank. So that's definitely a thing. Flood insurance, you have to think about that, especially if you're in an area that is not on a flood plain, but is near some, or in a flood zone, but is near some. It's very cheap. It might be $300, $400 a year for that kind of protection. And it protects up to $250,000 of damage to your home. That, to me, especially if, my family has a house in Florida, and it's on a lake, and it is not in a flood zone, but I'm buying flood insurance, even though I don't have to, because I don't have $250,000 in case of if Hurricane Helene came to my town and dumped a foot of water in my backyard, it would have been a disaster. So I think people sort of misestimate the flood risk, and I would think that if you're risk averse, you might want to buy it, especially if you don't live in a flood zone, because the maps just aren't good enough. They're not perfect. Floods don't read the maps. Let's put it that way. So what else? The things that you can do to mitigate your losses. So people think about insurance companies will take care of all my losses. I don't have to worry about that. It's not exactly true. they'll look at your insurance contract, and the insurance contract is like the agreement how they pay losses. And one of the things they'll do is they'll say, for example, we look at your house the way it was before the disaster. So if your roof was 10 years old, well, and it's a 20-year-old roof, we're only going to give you money for 50% of it. That's the deal you sign with. Now, people get upset with that because they don't really understand the deal they sign, which is, I don't want to blame them, because when you have a natural disaster and you've lost your house and they're giving you not enough money to rebuild, you're going, what's going on? But in essence, you have to sort of understand your insurance contract. Now, you can buy coverage that's more expensive, of course, that will pay you replacement rather than actual cash value. That's a little bit more expensive. Another thing is that if you bought your house 30 years ago, there was a certain building code 30 years ago. Even 10 years ago, there was a certain building code. Your insurance contract will allow repayment up to that previous building code. And people say, well, I have to spend all this more money because the building code has changed since that. And I say, well, we have a good homeowner advisor will tell you, buy the code enforcement upgrade. It's actually not very much money. But, like in Florida, if your house was pre-2000, you're in a different building code. So it's going to be a lot more expensive to rebuild your house with the new building code in place. So there's lots of things. And I would say that people are always looking for the best price for insurance. And one of the things they can do is they can talk to an independent insurance agent. And the independent agent works for a number of companies, maybe not State Farm or Allstate, but they work for a number of companies. And they can provide you with not just an insurance policy, but advice about the pros and cons of this policy versus that policy, options you may want to have. Most people just say, I just want to pay the lowest possible price. And with it comes no bells and whistles that you probably, if you were thinking about them, you might be interested in having. So I think the big thing about homeowners insurance is that people just say, I'll just give me whatever. And they don't think about what it is they're actually buying. And I understand it because the first time I got homeowners insurance, I was still an insurance professor. I did it the same way. I didn't think about it very carefully.
Considering that for the majority of people, their house is their greatest wealth, right, as their greatest asset. So it seems like you probably should do a little bit more due diligence than maybe looking for the cheapest plan, because as most things in life, you get what you pay for.
Yeah. And, in companies another thing, and I can't tell you who's a good company in this and who's a bad company on this. But one of the things that you would love to have is that you call up your insurance company and say, listen, Hurricane Zachary just wiped my house off the face of the earth. And they say, oh, here is a $542,000 check. That's what you'd like. And then you can rebuild your house or move wherever you are. Most companies will put, and I think there's actually some companies that will actually do that. Most companies want to check first, right? They want to look and see what happened to your house. Those are still good companies. Other companies will say, well, we need this, we need that. They'll delay, not unreasonably, but they'll delay paying a claim. And because they want to manage their claims payouts better. A good company will pay your claim with the minimum legal amount of proof you need. A company that's managing its claims will pay slower. But when maybe your house is destroyed and you get a check within 2 weeks, that's fine, right? 2 months, that might be okay. 6 months, we're starting to talk trouble here. So what you want to do is find out which companies pay relatively quickly, and you could, I just know that some have a reputation for paying very, very quickly but they charge more. So what you want to do is find that sweet spot, and an independent agent can give you that kind of advice because they see all the claims and they know who are the companies that pay quickly and those that pay not illegally slow, but slower.
I've saw on the news where, especially like in Florida, where if you're in a condo, you still have insurance, but that insurance is just covering the inside of the
Right.
your actual inside of the unit, and then your HOA in that condo will, part of that HOA fee goes for the insurance to cover the exterior of the condo. Then you'll see like all of a sudden their HOA dues are 5x or something in a year. What do you say about this?
So this is a whole different problem. So some of it is the same problem, but condos on the beach have this other problem because the management of the building is the owners. So it's like a club. And the club has meetings and they say, well, we need to have this exterior work done. Well, can we postpone that for a year? Okay. We need to have this engineering study done. Well, can we postpone that for a year? And so what happens is the building, there's an incentive for people. It makes perfect sense. No one wants to pay any more in HOA fees, especially for, studies and things like that. But as we saw from that collapse a couple years ago in South Florida of the condo, maintenance was deferred. Now insurers are saying, hey, I want to see your maintenance records. I want to understand that you are participating in the active management of the maintenance required of this condominium building. And so now insurers are saying, well, if you're gonna hide and defer maintenance and stick it to us, well, we don't want to be your insurer. So now, as part of the underwriting criteria, they look at it. So HOAs and condo associations that have done a good job can still get insurance. It's still more expensive because of all the other things that were happening. But HOA associations and condominium companies who haven't done that are going to have a very difficult time. They have to spend the money to remediate the problems. And that is a significant source of concern for insurance companies who basically have specialized in that business, and for condominium associations in South Florida. But it's actually spreading now. Now they're getting insurance once they learn what's going on in South Florida. They said, well, there's nothing special about people from South Florida. Everyone does this, so it's affecting HOA and condominium associations all throughout the country.
We were talking about some states that were a little bit harder to get insurance, and I was reading that Iowa was actually one of the states that was losing. Insurance companies were losing money, and they have something called like a derecho in Iowa. And you're teaching at the University of Iowa right now, so you want to talk about that?
So what I was going to mention this before, but like the convective storm, derecho is not a convective storm. I don't know what the heck it is. Just as far as I know, it didn't exist before 5 years ago, but I think it did. I'll talk about them in a second. But the convective storms, which are like hail, thunderstorm, and tornadoes, last year they accounted for a hurricane's worth of damage, like a Hurricane Milton or Helene's worth of damage across the United States. So Oklahoma, Kansas, Missouri, Alabama, wherever there's a tornado, we always think of this as kind of minor event. They are individually, but they add up to be the same amount as a pretty serious, or they did last year, a pretty serious hurricane. Iowa has convective storms, hail and thunder and wind. And then they have this derecho, which is a straight line wind storm with the power of a hurricane, which that's why I said this. The first I heard of this was 5 years ago when it happened in Iowa. And there's been one since, I think. But as a result, Iowa is stressed. And I think Oklahoma is also stressed. And it's because of these convective storms. And people might attribute this to like El Nino, El Nina, the sort of the cycles of weather. But I know that in the early 90s, people were freaking out about the exact same thing. Hail damage was a significant loss for in many states. Cars. I mean, I don't know if you've seen a hailstorm that's a serious one, but it'll dimple the living daylights out of a car. It looks like a golf ball when it's over with. And so that, I mean, you really can't fix that. Well, I don't know. Maybe you can. I don't know. But that's a serious. Think of all the cars that are outside during one of these events. Lots of them are. They also destroy roofs like nobody's business. It's like hitting them, with a dime size or a nickel size or even a quarter size pellet, and it loosens roofs and it causes massive destruction. And that's hard to, fix overnight. You have to get roofers out there and you have to estimate how much damage there was, and you have to put the roof back together. So all these things, these seem like nickel and dime things, but they add up to, as I said, a hurricane's worth of losses for 2023. So I think, one of the things that people in these areas that have these convective storms have to do is sort of think about roof design and roof building, just like they have in other parts of the country, but with the focus not on, cyclonic winds, but hurricane winds, but on cyclonic winds or hail. And I just think it's something that, if the building engineers have got this figured out, it's not that big a deal, in terms of remodeling.
Can you talk a little bit about the reinsurance industry?
Oh, okay. So yes, so that is. So I talked about sort of the demand shock for people who moved and the price of homes went up, and I talked about the supply shock from the pandemic, and then the inflation caused price increases afterwards. And then I also said something about, and location really matters. But what's interesting about that is that every insurance company just about also participates in another market, and this is called the reinsurance market. And the reinsurance market supplies insurance for insurance companies. And when everybody is trying to buy more reinsurance, guess what happens? The price of reinsurance goes up. And so the last couple of years, we've seen people, insurance companies asking for more reinsurance, and the reinsurance rates are going up. They actually are coming down a little bit, it seems like, this year, but we'll see. The market starts in June, so we'll see next June what the reinsurance market thought of this past year. But it looked like for this year, the reinsurance rates are going down. So that's kind of interesting, because people say, well, I really don't want to pay for Floridians to live in Florida. But if Florida insurance companies demand a lot of reinsurance, that affects the price of reinsurance. And, my Iowa insurance policy has some reinsurance in it too. So it's also affected by that. So this is a worldwide market. There's no free lunch, really, right? Everybody has some exposure to risk. And if they want to reduce that exposure, they buy insurance, and the insurance company will then buy reinsurance to help them manage their risk exposure. So we're all connected in that way. So people in China who are buying reinsurance, their reinsurance is higher because of people living in Florida too. So it's not like they can segregate off their market. It's a worldwide market for reinsurance. And if losses go up in Germany or Australia, that affects reinsurance markets, and it affects us here in the United States.
So do you focus mostly on homeowners insurance? I mean, it looks like your papers, but do you study other types of insurance?
So I've done some work on auto insurance regulation. And I did, during the mid-2000s, work trying to assess to sort of modernize insurance regulation. So it's regulated now at the state level. And people were saying, well, if we're an insurance company, we have to operate in up to 50 states, and we have 50 different regulators who have 50 different arcane ways of doing exactly the same thing. It's just very costly. So we'd like to have a federal regulator. We just have, it's like one-stop shopping for everything. And so we had a lot of work. And after all that work, I actually don't know what the answer is. I think it might depend on a number of things, like whether you're a life insurer or whether you're an auto, a homeowner, a commercial insurer. But what happened is that the financial crisis sort of took that off the table. Nobody cared about that. It was like a tiny issue after the financial crisis. So, I mean, we had conferences, and we had, congressional meetings and things like that, but it just sort of went away after the financial crisis. And so no one's really discussing that much anymore, although it's probably time for a comeback, because it seems to come every 20 years, it seems to refloat. So it's almost time for that again. I've also done work on tort reform, sort of litigation liability rules that change payouts during a lawsuit against someone else for harm. During the early 1980s, there was a liability crisis. Like public pools couldn't get insurance, municipal pools couldn't get insurance, so they had to close them. So there was no swimming. Lots of other companies had trouble buying liability protection. And the federal government actually sued part of the insurance industry for antitrust violation for this. And so I did some work trying to think about what state rules do we have, and can we compare states that have good rules versus states that have, well, I should say this rule versus that rule. One could argue that none of them are good rules, but sort of compare the outcomes in different states. And the result of that research, and it's not just me, lots of people have found this, is that the damages limitations for pain and suffering, those seem to have the only effects on insurance markets, or most strongly have the effects on insurance markets. Most other things don't, they're not that important. And part of it, I think, has to do with, I don't know so it's hard for a jury to assess pain and suffering. So you've had an injury, say you can't walk anymore, and jury has to figure out how much that is actually worth. And because there's no market for that, we don't have. It's just very difficult for people to sort of wrap their heads around. And so it in many cases it tends to be how good your lawyer is, how random the jury is, and how sympathetic you are. And people think that's not really justice. So they've done this sort of secondhand approach by just capping them at a certain level, even for gregarious cases. So I've done a lot of work in insurance and risk management, and taught a lot of students.
Right. Yeah, exactly. So, Professor, what's more dysfunctional in 2024? Homeowners insurance or healthcare? Or I should say, health insurance?
Well, I think if you work for a company that has employee benefits and you get your health insurance through that company, you think life is pretty good. And that is a lot of people. So for those folks, I think that health insurance is a good deal. For people that are regulated through or through purchase their care through or get care through Medicaid or through the exchanges, I think it's tougher. Medicaid doesn't reimburse physicians the same way they would from private insurance, and so physicians don't want to be Medicaid doctors. That creates availability problems for people that we want to have doctors available for. The exchanges aren't always profitable, and so companies don't want to offer policies. So I think people in that area, we thought Obamacare would solve a lot of problems, and maybe because we rushed the design of it, and in rushing the design of it, we screwed it up, and this screwing it up means that it's hard to fix because the politics are now in cement mode. So I would think that healthcare is a bigger problem for a lot more people than homeowners insurance is. But like I'm not in the Medicaid market or the exchanges, but I am now just recently in Medicare, and Medicare is going to go bankrupt. And we don't seem to have a plan for that. And so I think that's what makes that worse for a lot of people, is that we don't have a plan. And I think prices are probably going to go up, and people don't realize that they say, well, I've been paying in this for my entire life, and now I have to pay a premium too. And if I make too much money, I have to pay even more premium. You're going to make me pay even more on top of that. What did I buy, for the last 30 or 40 years? So I think that healthcare is probably going to be more problematic, because I actually think that, and we've had the shock in homeowners, and I think the shock's going to wear off because the homeowners prices are not rising as much anymore. Our employment our labor markets are back to normal. We have access to our supply chains again. So all those pressures on homeowners are reduced. But there's just lots of buildup of broken and things that aren't working very well in healthcare that I think are problematic. And I'm not a healthcare economist, but I'm a consumer. So, but I'm an informed consumer. So that's kind of my opinion about healthcare.
So what's a question I haven't asked you that I should have asked you?
Why can't we have a bundled homeowners and flood insurance product? And yeah, because you mentioned that in one of your comments that you sent me, and I thought that was a insightful question, and it has to do with, once a government program gets inertia, it becomes problematic. And so we have a national flood insurance program that dates from 1968 because companies wouldn't sell homeowners insurance and flood insurance. And if we think about the reasons they got out of the flood business, is that back in the 40s and 50s, we had a lot of floods. Our rivers weren't as managed as well as they are today. We also had little tiny insurance companies that were basically farm mutuals, like county-based insurance companies that were all along the Mississippi and Missouri rivers, and Iowa River, probably other rivers. And if you had a flood in one of them, they bankrupted all the companies all the way down the river. And today, we have large insurance companies. Even a small homeowners insurance company is pretty big. They have access to capital markets. They have access to reinsurance markets. They have access to other companies in their group. They can diversify across the country. So I think our insurance mechanism for this kind of risk is so much different than it was, 50, 60, 70, 80 years ago, that we probably could have more private flood insurance. And Chubb, which is a large insurance company, actually does sell add-on private flood insurance. Because if you think about it, the National Flood Insurance Program limit is $250,000. And most people have houses that are worth way more than that live in flood zones. So they have the opportunity to pay more. And so I think the future, and the federal government is horrible about flood insurance in the sense that it's not risk priced, because it's very political, as one can imagine. And they reinsure the same property that's been flooded numerous times. And I think, they do have plans to buy people out and get them out, but we haven't really progressed as much as I thought we would have since Katrina in this area. And so the federal government FEMA is trying to do a better job at it, and they're trying, but hopefully that they'll try harder.
And let's just say hypothetically you were in charge of, say, some like mega insurance, homeowners insurance program. What would be solutions that you would implement to kind of fix some of the issues that we have? Like, what would be solutions that you would propose going forward that can make sure that everyone in California and Florida and Iowa and Oklahoma has insurance in the next 20 years that's going to be relevant, et cetera?
That's a tough nut to crack. There's a couple of things that I think can help. One, and this is a technical thing, but it kind of, I think, matters a lot. So an insurance company, for everything but catastrophes, is allowed to sort of model what it expects its losses to be in a given year. So, and then if you think of a simple tax story where we have premiums minus our expected costs, well, what's left over is profits. Okay, and we tax those companies on that profit. For catastrophes, we don't let them model the expected catastrophic loss. They have to experience the loss first. So what happens is the company has revenues minus its regular expected losses. And then if it has a catastrophe, it's a gigantic amount. So it has an actual tax loss. But it might take 30 years to recover from that. And if we were to allow them to sort of smooth out their expected cat losses, their cost of capital, this is technical, their cost of capital will go down, and they could lower the price of insurance. Now, if you ask me to be honest and how big an effect that might be, it might be 3 or 4%. But it won't be 30%. It won't be, the marginal tax rate or anything like that. But everything that we can do like that helps. And, the IRS doesn't want to open up a hard to audit, hurricane catastrophe model loss deduction. They would like easy to audit things. So, but that's probably one of the reasons we don't have that. But I think now is the time that people recognize that our modeling skills are better. We should be doing this. And I would think that that's not a bad thing. I also think that local communities, especially in fire zones and flood zones, should be doing more to help people get educated. I would think that banks, when they give mortgage applications, should provide, guidance, because people aren't going to believe this is hard to do because people just aren't going to believe the bank. They want to get their mortgage closed. They just want to move in. And all this other stuff is just to them is extraneous. Someone to say, focus on this right now while we're doing it. It's the most important thing you own. Let's protect it in a way that makes sense for you. But if you bought a house, you know how exciting it is, and everything about the insurance or that title insurance or all those other things that to pay for, no one really cares about. But this is one of those things that you should focus on. And trying to build a better flood insurance product. And I don't know, this is a strategic thing that companies have to think about. Should we compete with the federal flood insurance program? Should we offer lower prices to get people to buy? I don't know the answer to that question, because I don't know how good our models are for assessing that risk. But that would be something I would want to know about, because I would think that if I were a good insurance company, I'd want to provide a product that was seamless for my customers. And because of various programs and historical facts, we have a different thing. And I think that's something that probably could be fixed. And get insurance regulators to be less resistant to price changes in the face of, here we have people say it's climate change. I think it's climate in general. We don't have really good short-term models of these things, but climate is changing, and we should allow flexibility in insurance pricing to allow companies to basically, on average, break even. They have to pay off their investors, but on average, pay them off. They shouldn't have to subsidize anyone, because insurance is a voluntary business. If you don't want to write insurance anymore, you don't have to. Companies can say, I respectfully decline to write insurance because I can't make any money. And what we want to do is not have them say that. Believably.
Yeah, if you're going to lose money every year, you're not going to stay in business too long.
Yep.
And I would think, like you're talking about, flood insurance in a private company taking it over. Nowadays with GPS and advancements in AI and whatnot, you think they'd be able to at least be able to update those flood maps more frequently and have a little bit more real-time information, right?
Yeah, so I don't know how they're built. They were after Katrina, people looked at them and said, these are horrible. These go back to the 60s. And every time somebody builds a new house in a neighborhood, it really upsets the flood map. So they have to be done better in real time. And I just don't know if the federal government has the money to do that. But a private company might. You might be able to sell this information, build a better flood map model with equity capital, and then sell it to insurance companies. That might be a thing.
My kind of final big question before we wrap this up is, we really haven't talked too much about this, just a little bit, but the big topic of wildfires, and especially California, they had some in Colorado. Was it last year or a couple of years ago? The Marshall Fire outside of Boulder. And
I was there for that.
Oh, wow. Okay.
My daughter goes to the University of Colorado. So
right. And then, Yeah. And then, of course, I mean, I forget when we had the big or the fire in Lahaina, Maui, that had to be, what, a year or two ago as well. And it seems like the fire stuff might be a little different. Is that kind of more like forest management or
So,
forest?
that's a super good question, and I just did a bit of reading on this, so I have not the same depth of knowledge I have about hurricanes, but there's probably three culprits: the weather, like lightning storms. Oh, four. Arsonists. Arsonists are a thing now, and which struck me, that people start fires on purpose. A lot of them get arrested too, but they start fire on purpose. Lightning, which is, God starting a fire on purpose. The next one is uh, electric utilities whose transformers spark either as a result of a malfunction or, um, other kind of weather that breaks the line and causes a spark. And then individual negligence, not arson, but, I started a fire in my house and it burned down my neighborhood type of thing. So those are four different things, not counting the forest management. So I can't tell you which one is the most important. I think lightning fires are the ones we have the least amount of control over, and that utilities, especially in California, the the I think it's PG&E, Pacific Gas and Electric, it went bankrupt because it was charged with starting, its equipment, starting a fire that was pretty disastrous. So, one of the things two of the things that people are talking about in California is, better resource management of fuel in the woods. The other one is upgrading the electric utility infrastructure to limit the number of fires caused by it. And then, the last couple of years has been California's just had arsonists running around starting fires, which I don't understand that, but that's a whole different podcast, I suppose.
Do you know of those four main attributes? Which one, kind of the percentage of the breakdown? Like, what's the highest percentage of the cause for fires then?
I have a table someplace that I did look that up, but the California, it's called Cal Fire. They have an annual report, and in that annual report, they list that information. I just can't recall it off the top of my head.
Because it seems at least for the forest fires, that's more like policy to me driven. I mean, like the hurricanes and things like that are just more, freaks of nature versus like some of these forests, especially if you have arsonists that can start things. I mean, that's not even, I guess that's not a policy issue. That's just more, how do you get people to stop doing stupid things? But especially like with the power companies, that's basically what happened in Maui, right? And Lahaina, where you just had overgrown shrubs, overgrown trees, etc.
So I want to blame the utility a little bit, but I also want to blame the state public utility regulator, who doesn't want to put into the rate fees the cost of line maintenance and things like that. Because it is costly, and they say, "Oh, it's like deferring the maintenance in the condo." It's the same thing. And they get to oversee that. Say, we're not going to let you put that in the rate base. We're not going to let you charge for that this year. And so the companies, they don't have a budget for it, and so they don't do it. So people blame the utilities, but I really think it's the regulators share some blame too.
So what percentage would you say in California would just be kind of based on policy regulation there?
I can't remember the figures, but I would say it's not as it. If you think about fuel, fire management, and cleaning out and control burns, I'm sure there's people that know that. I just don't have a.
What was the cause of the Marshall fire outside Boulder? You remember that?
I think it was negligence.
That was negligence as well. Okay. Today's guest has been Dr. Martin F. Grace, who is a professor of risk management at the Tippie College of Business at the University of Iowa. Appreciate you spending over an hour with us today. I know you got more important things to do, Dr. Grace. So I got two final questions. Just leave us with a final thought. And then secondly, if you'd like to provide any information of how people can find you or find, your research papers, etc., if you want to provide that, just give us that information as well.
Well, and thanks for having me on your podcast, Jesse. I think this is kind of an important part of what professors do, is to sort of talk about the research. And if you want to look at other things I've written, ssrn.com is a place for people. It's a repository of research, and it would be just www.socialscienceresearchnetwork.com, and just put my name in there. I can also be reached at MF Grace, Martin Francis Grace, MF Grace at uiowa.edu.
Can you leave us with a final thought?
So I want to say that people often think of insurance as a secondary thing, and that's not that important. But when you think about the amount, and I've mentioned this before, when you think about the amount of money and time you spend in your house and on your house, that this is something that you should be a bit more proactive in thinking about protecting. And so I would just, encourage people to actually look at their insurance policy, which they probably haven't done since they bought it, and sort of say, what does it cover? And maybe Google some of the things on there, and they'll get a good understanding of what it is that they bought.
My dear friends, that is it for this episode of El Podcast. Once again, if you're not yet subscribed, please subscribe on YouTube as well as Rumble. You can also find us on Spotify and Apple Podcasts, or wherever you get your podcasts from. We thank you all from the bottom of our hearts for watching and listening, and we will see you on the next episode.